Yeah, sorry about that. I just had to take a phone call from my wife. Um, so s as you can see um, here, right, we have we finished on the point of inventory, right? So we were here. Mm, sorry, we were here, yeah. So you can see increase and decrease in inventory. So what you need to think of here, right? If you're showing a positive number here, an increase or a decrease in inventory, right? So what happens when you increase your inventory? Money is tied up in it, right? So you're reducing cash, you're reducing the cash that you have, right? So what you need to, what that says is if you've got an increase in inventory on your balance sheet, that's a reduction in your operating cash. If you have a decrease in inventory, it means you should have more cash in your business. Okay, because that's inventory. You've got to think about it. It's like goods that you're holding. So if you're selling footballs, you have more footballs in your business. Therefore, you must have invested more money in your business or more cash into your business. You must be less, so you must have less cash now. However, if you've got a reduction in footballs, you would expect those footballs to have been sold. So therefore, you would have an increase in cash. Receivables are the same. If you have an increase in receivables over the between the 2 years, between 2015 and 2016 is what we're looking at, you would have a decrease in cash because receivables is money owed to you. Yeah. However, so if you have an increase in that, there's an increase in money owed to you, but it hasn't been paid to you in cash. So that's a reduction in cash. If, on the other hand, you have a decrease in receivables, it means more people have paid you. Therefore, you have a increase in cash. Okay, so that would be an increase. So what we can see where you do this is you go to the balance sheet and you look at it and you say, see, you look between 2016 and 2015. Yeah, please. No, that's fine. Thank you. So you would have 150 to 153. So you can see there's been a decrease in inventory, meaning an increase in cash. Okay, You've, and that's of 3. You have had a decrease in trade receivables, an increase in cash, right? So 174 minus 167. Okay, 7. Great. And that's 3. And then your trade payables is the last one, and you've had an increase in your trade payables of 5. Okay, so if we go down here, because you would just take 155 from 5, see, okay, see you've got 5 here, yeah, 5 increase, 7 increase, and a 3 increase. And the way you get to those is you just minus 1 year from the other year. Uh-huh. So you minus 153 from 150. So the easiest way to do that would be for trade inventories and trade receivables. If you want to get that, if you get confused about the signs or whatever, for inventories and trade receivables, if you start with the year before, yeah, so start with 2015 and we do 153 minus 150, that's plus 3, right? And then 174 minus 167, that's plus 7. So if you wanted to start with those and you wanted to do it that way and you couldn't remember why it goes up or down because you get confused by that, for inventories and trade receivables, always start with the earlier time and then deduct it that way. However, for trade payables, do the opposite way around and do start with the most recent year and minus it from the year that's already passed. So for trade payables, you would do it for 2016. You would start with 155 minus 150. If that's positive, you leave it as a positive value. If it's negative, you put it as a negative value. Whereas for current assets, you would start with 2015. So inventory 153 minus 150. Yeah. So do it that way. That might be easier for you to remember. Um, and yeah, so then when you get a positive or negative value, you just add that or take that away from your cash under operating activities here. Okay, so you'd have an increase slash decrease in inventory, yeah, so you'd put it in there. Okay, so then we get to that number of 163. Then you just go to your income statement, you take off your interest paid, which is the same as 15 here, so you add it back in and then take it away. and income tax. Okay, 40. Where is it? So it should be on the balance sheet because you won't pay this year's income tax, which is 30. Okay, so we've got, okay, yeah. So what's happened is you can see the difference. So with your taxation, you start with 30. Okay, that's the income tax you'll need to pay. Then you take the difference between these two. So again, start with 2015. Yeah, so we do 37 minus 27, which is 10. So if there's a difference here, yeah, because this is your current liability, yeah. So as it's in your liability section, you've got tax liability of 37. If that tax liability goes down, which it has done, that means you must have paid some of it off. Okay, so it's in your current liability section. If it's in your current liability section, start with your 2015 and go to 2016 and take it away from it, and you get 10. So if you do 37 minus 27 plus 30, you get 40. Okay, and 40 is what you will see in your answers as your income tax paid. Okay. All right, so perfect. You've got that part then. Okay, and then additions to intangible assets. So the key thing here is, again, you're using your balance sheet, and you're using your balance sheet to identify where you have increased your intangible assets. Um, and you again use the beginning part of the year and the ending part of the year from previous and current year. Okay, so you would use your 2015 and your 2016 numbers. Okay, so let's go to the way you would do it. So what you have is you want to work out your addition. So amortization is like depreciation, so it's a reduction. Okay, and the way you do this, so you have to add the amortization. You see this amortization back? You add in 3,000 to your intangible assets here. So you would do 64, 52 plus 3, 52 plus 3 minus 64, which is 9. Okay, so I believe we should get 9 here. If we don't, then additions to intangible assets, which is minus 15. So I might have used the wrong one. Oh yeah, sorry. So I did that just the wrong way around. So to get the additions, you need to take the amortization here, take the 3,000, add it to the ending figure here, because you want to remove um, that so you can get the true value of what you've added to the business in terms of that. So just add back in the amortization to the most current year on your balance sheet. So to the 64, so you would go 64 plus 3 minus 52. Therefore, as amortization was 3,000, you must have added 15,000 into intangible assets. Thank you. Meaning that you've meaning that you've spent an additional 15,000 in cash on intangible assets. Okay, so you add that amortization, and it's the same with depreciation, as you will see, because remember, they are not cash expenses. Okay, investment income received, so that one that you minus there, you just put it back because it's, remember, investing activities. Everything's got a heading. Everything's got a heading. Okay? Okay. Proceeds from the sale of equipment, 27. That's simple. It's just here. They've given you that, so you have to add that into investing activities because anything investment activities comes from the sale or anything to do with that idea of buying or selling goods, or but not goods, but particularly capital machinery, or buying and selling shares of another company, or any form of investment like that. Because you've got to remember your equipment and stuff is an investment. So if you buy or sell it, you have to put it in the investment activities. Okay. And then the purchase of equipment, 96,000. So purchase of equipment. Okay, so the loss on the sale of equipment, right? Loss on the sale. So if you made a loss, yeah, you sold your equipment for 27,000 and you made a loss on it, which means you sold it for 5,000 less than 27,000. Okay? So it must have been 5,000 pounds more expensive. Yeah? So what you do when you make a loss, you take that loss and you add it to what you sold. Yeah, but if it was a gain, you would deduct it. So you take that loss, yep, and you add it to the 27. Yeah. So and then you do so you take you add that on to the 27,000. Okay. So you do 5,000 plus 27,000 and that will give you the value of the equipment that you sold that you had on your balance sheet. Okay, so you do 5,000 plus 27,000. Then, yeah, you take the depreciation and you do exactly what we did with amortization. Just add that 20,000 to the sum of the 5,000 and 5,000 and the 27,000, which is 32,000. So add the 20,000 to that, you'll have 52,000. Then that 52,000 you add to the most recent value of your equipment. Yeah, so you add that to the 201,000 minus that, then from the original value that you had, which was 150,000. Yeah, and you've got 96,000. And as you can see here, once you get that, so you add that to the 2016 amount. Yeah, once you've got that here, yeah, so 96,000 here. Yeah. So it's literally just that when you've got these situations, just add it to the when you're working out this, like how much you purchase for equipment and additions to intangible assets, add the amortization and depreciation to the most recent year and add and adjust the gain or the loss for the value, as I mentioned earlier, and then you add that to the most recent year and you just deduct that total from the previous year and you will get that amount. Okay. And then, okay. I just need to double check something. Okay. Um, so this final part, proceeds from the issue of share capital, 42,000, repayment of long-term borrowings and dividends paid. So repayment of long-term borrowings, let's have a look. That you would usually come on your liability section. Um, is this the same? That's the wrong balance sheet. Um, okay, so let's look at our long-term borrowings, non-current liabilities. So you would just do 52,000 minus 90. That's 30. That's 38,000. Is that the number that we were getting? Otherwise, there might be another adjustment we need to do it. No. So you just literally go to your balance sheet, yeah, And as you've reduced your, remember, if you reduce your liabilities, it means you're losing cash. If you increase your assets, you're gaining cash. So as we've paid back our liability, as we saw from our balance sheet, cash flow from funding act, that's a reduction in cash of 38,000. Okay. All right. Remember, it's from that amount there, 52 minus 90, 52 minus 90, 38. Yeah. So dividend. So yeah, if you want, so you can see where the share capitals come from. Yeah. So we've got, where do we have it? So the final part, we need to work out what the share capital, whether there was any increase in share capital. And we can see there was, right? We can see the difference between 127, 127, 110, and 225 and 200, right? So we know that we know um, that um, we have increased our share amount. Yeah, clearly. Okay, so what we need to do is we need to understand what exactly that is. Okay, so and we want to understand what our dividend payments were. So the way we do that is we need to use the balance sheet again. And the way we do that is you use exactly the same way that you've been doing it before. Um, exactly the same way that you've been doing it before. You will go from 1 year to the next. And let me just stop this video because otherwise it's going to be too large to upload.